As everybody gets settled, I want to welcome you to the second session of the 9th Annual Real Estate Impact Conference. It is so much fun to see people who used to be students, who are now successful in the real estate business, coming back, coming to the conference, sponsoring the conference. We have built an incredible network here for the University of Miami, so thank you very much. And if you want to see the strength of the UM network, you have only to turn to the center of the program to see the names of the sponsors that are here in the middle of the program. This is a real who's who of who's important in commercial real estate. And the other thing that I would like you to take a look at some point soon is the inside front cover, because I have been at the University of Miami since 1982, which is like older than a lot of people in this room. And we have built at the University of Miami a very, very good foundation of educational programs that touch commercial real estate. For those of you that I don't know, my name is Andrea Hewson. I'm the academic director of real estate programs at the Miami Herbert Business School. And we are part of the collaboration that plans this conference. So every year, I wake up at 2 o'clock in the morning the night before the conference, and I'm afraid I'm going to be standing up here looking at an empty room. Not today, so that is really, really good news. I also want to talk just briefly, since we're a little bit on Miami time, about the fact that we are lucky enough to have sponsors who are so generous that there is a little bit of money left over after the expenses of this conference are paid. And we use that very, very judiciously to support real estate initiatives and to benefit students in our programs. And there are two that I want to just briefly mention. My husband, who is an academic, is always talking about the evil empire that is real estate. And I'm always telling him that he is completely wrong. And two programs that we have initiated to try to help address the social needs of some parts of the community are we now have an impact investing in commercial real estate competition. It's a case competition. We had 11 schools submit projects this year, and the top 3 will be here in April, very early in April, to have their projects judged. Also this summer, in partnership with the Real Estate Executive Council, we're having our second program for high school children who are economically disadvantaged but academically strong. They'll come and they'll spend 3 weeks at UM learning about commercial real estate as a possible career, because we've decided that we really need to get people at the level of high school before they go to college, to have them learn about what a fabulous industry this is and that the pathways are open for them there. So as you are here enjoying the topics of conversation for this section and the next session, also realize that you are helping things for the next generation of real estate scholars. So I thank you very much for that. It is my pleasure to introduce our next conversation, which is between Deb Cafaro, who is the CEO of Ventas, very, very large REIT in the medical space. And joining her on the stage is Patricia Will, who is the CEO of Belmont Villages, which is a real estate group that focuses specifically on innovative aspects of senior housing. I'm very proud to say that in 9 years of doing this conference, this is the first time that we have had a conversation where everybody on the stage is female. So we're making progress here. And secondly, I'm willing to bet that nobody else in this room has a Stanley Cup ring. Deb has one. It's really big. She has 2, so she has 1 on. Let's put it that way. It's really big. So, and you will learn some more about both of these women, both on a personal basis and about the space in which they operate in our next conversation. Thank you very much.
She has 2 Stanley Cup rings, not just 1. And the first thing, I've been friends with Deb Cafaro since we both entered the industry in the late 90s. very different spaces. She taking the helm of a $200 million market cap company and turning it into this behemoth of a $25-30 billion market cap company, while I trudge along as an owner-founder making assets in the seniors housing space. What a lot of you don't know about Deb is all the monikers that come with this powerful package. Forbes named her one of the top 100 women, most powerful women in the world. The Harvard Business Review named her as one of the top performing CEOs in the world. And the one that she's been named by NAREIT, one of the top 100 most influential people in healthcare. Think about that. Head of a REIT being the most influential people in healthcare. But the one that's my favorite is Jim Cramer, who named her as one of the 21 most bankable CEOs in the world. I love that. So again, I've watched this company grow remarkably. And as I turn to you, Deb, and I think about the inflection, the fulcrum that you sit on, between healthcare and real estate, healthcare being an asset class that when we both began wasn't even an asset class. Talk to us about the interaction between those two and why the rates of return have been historically and prospectively so good.
Happy to do that. It's so great to be here with everyone. We are going to try to have fun this afternoon, so please send in questions that you may have. Thank you for the kind introduction. I am very, very lucky to do what I do. We're in a great industry. Ventas, our company, operates in 5 verticals, including senior living. What's really exciting about where we sit is that when you look at the GDP in the US, whatever it is, 20 trillion or something annually, real estate and healthcare are each about 20% of the pie, 2 of the largest spaces. And here we have Ventas, our company, really sitting at the exciting intersection of both. And what Patricia says is so right. I started at a company that was a veritable dumpster fire of problems and troubles, and I couldn't even, you would run out of the room crying if you heard them all. But it was also a time when healthcare real estate, however you want to call it, and that runs the gamut from hospitals, acute care hospitals, at the most medical on the one hand, to independent living or over 55 apartments, age restricted on the other side, and everything in between. It was not a recognized real estate asset class. And over the 20 years that I've been the CEO, a lot of what we've done at Ventas has really been the intellectual work to really show the real estate market how to think about healthcare assets, how to price them, how to understand the risk-reward characteristics. And we made the case very early that you were getting core-like returns with good demand profile at an above-market yield. And that drew kind of real estate investors into healthcare asset classes. And by doing so, and obviously having great operating partners like Patricia in the industry, we believe that we institutionalize the asset class. And that's been very important for valuations, as you've seen those cap rates go from, into the double digits down now to a 5 cap rate or lower in certain asset classes. And on the other hand, we had a story to tell to the operators across these verticals. Most of the healthcare real estate in the US has historically been owned by, and it's $1 trillion market, owned by the operators. So we also wanted to try to make the case to those owner-operators that there might be a more efficient way to own and hold those assets, and that is in the hands of a dividend-paying, stable cash flow, diversified real estate investment trust named Ventas. And so really the 20-year story has been about trying to help real estate investors think about and invest in healthcare real estate, and continuing to try to talk to owner-operators of healthcare real estate in this trillion-dollar market to say there is a more efficient way to think about your real estate, and perhaps you ought to think about separating operations and the real estate. And that's been my life's work for 21 years, and I do think, to use Matt's innings analogy, we're still in the very early innings of fleshing out that story.
Deb, you yourself has described the morphing of this dumpster of real estate as a business fairy tale.
Yes.
Most of the people at large think about Ventas as one of the largest, if not the largest, owners of my asset class, seniors housing. But if you look at the company, $2 billion a year of NOI, only about half of it is coming from senior housing assets. Can you talk about the balance and what else is in there?
Yes. So there's about $2 billion of NOI. The 5 verticals that we're in are senior housing, which we believe in deeply and have committed to. We also have a post-acute, which includes a very small skilled nursing business, long-term acute care hospitals, and inpatient rehab. We're one of the largest owners of medical office buildings and outpatient in the U.S. We also have a really growing business in very exciting university-based, we call it research and innovation, but it's life science, medical, and technology buildings, one of which we own with the University of Miami. And then we have a stake in a very successful acute care hospital company that does a lot of work with not-for-profits. It's a for-profit company that partners a lot with not-for-profits. And so those are the 5 different businesses that we're in.
So I'm the mom of a seniors housing company, but I'm also a bit of a finance junkie. And one of the things that I've found most interesting is your strategy for managing the balance sheet. Can you talk to us about the spin-off of the skilled nursing company, and more recently, the public company Ventas leading a billion-dollar fund as a general partner?
Okay, so Ventas is, you can think of us as a third finance, a third real estate, a third healthcare in terms of the skill sets and the way we think about our business. And raising capital and manage the balance sheet is exceedingly important. So the general idea is raising capital at a lower cost, and that's partly why we like the large diversified model. It gives us great access to every capital market imaginable. And then investing it wisely in these different verticals. And we have followed a pattern where on a very low leverage model, BBB plus balance sheet, we have been able to drive 22% compound annual returns for 20 years. So I believe in sort of the big diversified company with relatively low leverage, being able to drive outsized returns. A lot of what we do is figuring out capital allocation. So there came a point in time several years ago, we started out really in the skilled nursing business. It is a tough, tough business. A lot of people have made money in it, but they're few and far between. I always say the business ebbs and flows, but it ebbs a hell of a lot more than it flows. So we got into a time period a couple of years ago where we still owned a sizable skilled nursing business, and the real estate investors just loved the business. They were putting a 7 cap on a business that was an 11 not too long ago. So we figured out a way to do a tax-free spin-off of the entire business to our existing shareholders with the general idea, when we did it as a dividend, a tax-free spin, the general idea was if they loved that at a 7 cap, we would let them invest in that, and we would take the proceeds from that now separately traded public company and really redeploy it into areas that we thought deserve more capital allocation. And so that's what we did a couple of years ago, and I haven't looked back. I'm really happy that we did that. And those assets are now in the hands of more of a pure play skilled nursing operator who can drive the business and allocate capital into the way that we were not prepared to do so. P.S. The price and time were great for our shareholders. Now you mentioned, so when I think about sourcing capital, again, it's always wanting to find the right pockets of capital, and we just initiated as a public company a new open-end fund. We are not pioneering in it. There have been a couple of REITs, most notably Prologis in the industrial sector, who have done this successfully. But it really has not been a widely adopted or widely successful model. And the general idea is, as a REIT, I believe in the REIT model. REITs have delivered 12% returns for 40 years. I think on a risk-adjusted basis, they compare very favorably to the private vehicles with the added value of liquidity. So I think that's great. But as we all know, REITs are only 20 or 25% of this giant commercial real estate market. And so there is so much money on the private side that doesn't want to invest in the public securities, and they always say it's because of volatility, which we saw this week in tremendous measure. And so the idea was, why can't Ventas use its brand, leverage its infrastructure, our industry knowledge, to establish an open-end fund for institutions that would offer this other option to that huge pool of capital who wants core assets in healthcare, and we would brand it and run it, and we would be the GP, and we just hopefully will close our initial closing of the fund this quarter with about $650 million of equity capital commitments, which is really good for a first-time fund sponsor. And then we would hope to grow it and get a lot of traction. And we view it as another arrow in the quiver and the ability to serve a need of capital. Capital is lining up for some of these funds in the life science, medical office, and senior housing space. So I sort of think, why not us? And so we've now formed a business that will cater to those institutional investors.
So I was going to ask in that regard before today about your stock price, but having listened to Matt, I'm not going to go there.
It was good, now it's bad.
So up until the coronavirus, you might have blamed that on supply and demand in seniors housing or some other thing, but I do want to talk about that.
Good.
So let's talk about seniors housing, which is half of you anyway. This is a sector where we all know the demand curve, and my generation, our generation of baby boomers are coming, but we're a little too soon. And there's a lot of talk out there about a glut of supply largely created by liquidity. How do you think about that? How do you think about it with respect to how you manage your balance sheet, but also how do you think about it with respect to the future?
Good big questions. I mentioned earlier with passion that we do believe in the senior living business. I think that it is so amazing that we have buildings where 60 or 70,000 seniors call home with the idea that they can age and live in dignity under the care of operating partners like Patricia's company. I mean, it really is an amazing business to be in, and it does have tremendous demand tailwinds. So that's all great. And those tailwinds really come from the oldest old, who the 85 and over, who are growing at the fastest rate of the US population. That's really our customer base right now. And then the baby boomers will come along, obviously, to use the product in the future. And because of those demand tailwinds, what we've seen is there is definitely oversupply in many of the US markets, and that has led to declining occupancies and declining NOI in these businesses over the past couple of years and into 2020, and perhaps beyond. What we do know and we do see is that the number of starts that are shovels in the ground in the fourth quarter of 19 were dramatically lower than they have been at sort of the peak of starts, which, depending on the markets, were between sort of 15 and 17. So we know that the leading indicators of supply are materially improved. We know that demand from the cohort of users is starting to increase after the depression babies were somewhat subdued. So that starts to grow at 3%. And the holy grail is the idea that the number of people in those cohorts who use the product, the penetration rate, hopefully that is going to increase because people believe in the value proposition, they believe in the care, they believe in the socialization that you receive from being in one of these communities. And with that, we believe those demand tailwinds, certainly in the intermediate term, are going to be positive for the business. But right now, it is a very tough, supply-demand equation. But it is turning in our favor, and NOI will follow.
So I hesitate to ask this question in a room of real estate developers because you'll all go out and build something.
Please don't.
But are there markets that you particularly like, and markets that you particularly don't like? And if you don't want to answer, the ones that you like, I'd feel better about it since I'm developing.
Well, your building's always filled, it seems like, no matter which market they're in. So that says something about what you're building and how you're providing care. Look, it's always the case that the low barrier to entry markets are the ones that start with the development first. And we did see that. The Atlantas, the typical real estate oversupply, low barrier to entry markets, those starts peaked in, say, 15 and actually seem to be getting better. I'll call those the Brookdale markets, Brookdale being a large operator. And then the higher barrier to entry markets, which are very attractive in many cases, the building started later, more like 17, and we're still in the process of seeing those deliveries. So it's not that we like one market more than the other, it's more timing, and of course we're always looking at the growth in the senior population, the growth in population generally. And one wild card that we've really thrown in recently is the change in the tax law with SALT, state and local taxes, and whether that's really going to create a change in behavior where we might have thought the projections for employment growth and population growth were going to be one way, but that actually may shift to some of these other markets that are lower tax burden states. So,
like here, Steve
like
said
here.
He was moving to Miami, or moved to Miami. Who from New York hasn't?
Exactly.
And Chicago.
Exactly.
So let's talk a little bit about the global profile and whether you have any ambitions there. Deb just hired a guy named Justin Hutchins, who was running one of the largest seniors housing and care companies in the UK. You may not know this, but one of your investment officers recently toured a building that I built, a mixed-use seniors housing and healthcare complex that I built in Mexico City. How do you think, and
She said it was amazing.
She also said, "Don't tell Deb I came." Talk to me a little bit. Yeah, and we see the global population actually, with respect to aged seniors and the people underneath them to take care of them, in many places in more dire straits than America. How do you think about that? Would you invest overseas? Are you running away from it?
We're large in Canada. I'd love to talk about our Montreal senior living investment because different operating model. And we are in the UK as well with a small footprint in the hospital and the senior living space. We absolutely have global ambitions, but I will say that the opportunities in North America are extremely great. The ownership of institutional quality healthcare assets by public REITs is still only about 15%, very fragmented still, and so lots of opportunity. And interestingly, when you look at some of the Western developed democracies and Japan, you have great demographics, but the yields are exceedingly low, driven in part by the stats that Matt talked about in terms of negative interest rates and so on. And the growth rates are low in continental Europe and negative in some cases and in Japan. So that has, between the cost and the uncertainty, the risk profile of us going abroad, and the yields, that has kind of tempered our global ambitions, at least for the time being. There are other places like China, Mexico, Brazil, et cetera, where you have growing middle classes and you think, gosh, this would be a great place to invest in healthcare because after your family is fed and has a roof over their heads, they want healthcare. But again, it's been very challenging from a currency rate. And that's not what our public shareholders are paying us to do.
Hey, so far the Mexican currency has gone in my favor. But you're right.
You can't really hedge. You can't hedge, and so it introduces a level of volatility that doesn't translate into a high equity multiple for us, which makes it hard to do.
So I think the title of this session was something like Riding the Silver Tsunami, so you can picture a lot of old people on horses that are coming over the wall fast and furious. And when we think about that, obviously, again, we think about seniors housing. But it's much broader than that.
Yes.
So let's talk a little bit about healthcare real estate assets and how they're going to fare, no matter what. We'll come to the political environment in a minute. But how they're going to fare when the largest users of healthcare are seniors, and there's 47 million of them now, 10,000 baby boomers a day turning 65, and there's going to be 76 million of us using healthcare.
Right.
How does that fit into your equation?
Well, again, when we talk about what we do, so much of what we do is just demographically driven. And I'll just touch on two of our business lines and the way we're trying to capture this growth. So as a large owner of medical office buildings and outpatient, that really caters to that over 65 Medicare eligible beneficiary because we know that cohort spending twice as much on healthcare as a younger cohort. They visit the doctor, 5 times as much as a younger individual. And we know thematically that the trends in U.S. healthcare are to try to move activity to a lower cost setting, which often is the case in the medical office building business. So that's a thematic that we've invested in that is a core assets, kind of steady eddy growth. I think our buildings have 36 million visits every year where people are getting health care, and we're proud of that. We'd like to be associated with some of the leading hospitals in the country because that's really the main indicator of whether your outpatient is going to be successful, and that is which hospital you're affiliated with. So we're taking advantage of that baby boomer cohort while they're waiting to get into senior housing in the medical office. And then I mentioned this life science business, which we're in over 6 million square feet now and almost 2 million under development, typically with universities like Penn and Duke and Yale and University of Miami. And that is really catering to this idea that the genetic research and so much of how we're going to treat chronic illness as the population lives longer and ages is being developed in these buildings. And it is super exciting to build this lab space. The predictions are that 171 million people in the US are going to have a chronic condition by 2025, so more than half the population. A lot of us in this room probably have the same. And when you think about how are we as a country going to treat these conditions in a way that keeps people out of high-cost settings and helps them manage these conditions in a cost-effective way that also enhances their life, this is what's being invented in our buildings. And it is by far the most exciting part of our business. We're really putting a lot of capital behind it. Going to a place that was, an old tobacco factory in Durham that now is basically literally curing cancer with biomedical research is pretty incredible. Going to Penn and seeing that they have cured blindness, a certain kind of blindness in our building is really just mind-blowing. And so I really enjoy that part of the business, and it is also very demographically driven.
So this is a little bit politically charged because it has to do with everybody railing against pharma. So I had the experience over the last couple of weeks of forgetting my new insurance card because we changed carriers. And I went to the pharmacy to renew my normal stuff, which is garden variety generic. And instead of paying my habitual $20 or $50, it was $1,100. And I don't take much. And we see guys on both ends of the political spectrum that are ganging up on pharma. The argument is that we are the petri dish of innovation and research for all of these cures. In the political environment, is that going to be sustainable?
That's a great question, and I do see both sides of it. There is clearly some predatory pricing on the pharma side that is unjustifiable, and I'm sure you've read about some of it. On the other hand, this is one of the parts of our country that is a leader. People think about Silicon Valley and technology. I would say innovation in gene therapy and some of these other incredible discoveries. We are the leader, and it's an area we should not cede to the rest of the world. That having been said, it is expensive. There are a lot of failures. The winners have to subsidize the losers, obviously. And on top of it all, often the drugs, after a certain point in time, are sold very cheaply around the world. So in some ways, Americans are subsidizing the rest of the world getting the drugs cheaper. And that is a bit of an unsustainable situation. But I strongly believe that the ability to have these groundbreaking cures is going to bend the cost curve in the right way, make people's lives better. But there will have to be some compromises in terms of profitability because, as you say, both sides are after the pharma industry.
So this may be a stupid question, but in that regard, Medicare for all, what do you think?
Well, I will put my biases on the table. I believe that basic health care is a fundamental right that everyone, this country, should be able to provide. And there are ways to do that. The Affordable Care Act was a good start. I believe in the individual mandate. That is, for people, the way to bring down costs for insurance for everyone, as we do in our health care plans in our employers is to have the law of large numbers, bring in everyone into the pool where everyone pays approximately the same amount, but at different times of their life, they receive more or less services because that's the time in their life. And insurance itself, if you think about your employer plan, is really a big cross-subsidization. Young people subsidize old people, well people subsidize sick people, and we do that at our jobs all the time. We don't think about it, but we do. And that is what the Affordable Care Act is trying to do writ large, and it's trying to bring the delivery of health care at the right place, the right setting, not the most expensive setting, which is the emergency room, and thereby bring down the aggregate costs. So the Affordable Care Act is flawed. It was a first step, but it is the right direction, I believe, to go to provide basic health care to everyone and do it in a way that's sensible. And those of you who are here from hospitals know that we pay for it anyway. We just happen to pay for it in a gerrymandered system that doesn't make a lot of sense and is the most expensive way. So why not acknowledge that, try to build out something reasonable that we all can kind of sign up for and then refine as we go along. Medicare for all, I think, will not happen, and I don't believe that most people in the United States are in favor of another large government program around healthcare. It's a step too far. So I'm in favor of evolution, not revolution, but continually expanding the pool of people who have access to basic health care in the United States.
Under the current administration, those of us in real estate have seen, enormous windfalls hither and yon and everywhere. As a public REIT, maybe a little bit less so. But under the current administration, have you seen changes in the business that you would like to see sustained?
I would say that it's a mixed bag. I do think that immigration and trade policies have not been beneficial, while some of the tax benefits have created some growth in the economy that has been beneficial. Some of the tax rules for real estate have in fact benefited REIT investors, and so that's been favorable.
So that's probably, we have a lot of students in the room, so that's probably going to lead us into a conversation about career and career development that I'd like to preface by saying that my industry, the seniors housing industry, is going to have to create 1 million jobs between now and 2025, from leadership all the way down to line caregivers. And immigration policy, I think, is going to be a part of that.
Yes.
Deb, you've had an unconventional career. We've all products in this industry of second careers because of how old we are. But you started as a lawyer and then morphed into a CEO of a public real estate company. Can you talk a little bit about that evolution as we're talking to young people who are thinking about their first career moves, or alumni who may be thinking about what comes next?
So my career has been super unconventional. I know they teach you in business school, which I never attended, about how to be very planful about your career and take steps toward the goals and so on. And I really approached it as what I am, which is a working class girl from Pittsburgh who was always very interested in just getting any kind of opportunity and always learning as much as I could, and literally, as my parents taught me, always trying to contribute as much as I could, to add value, to be useful. And so that was really my career in a nutshell, because I just, every time someone gave me an opportunity or I saw an opportunity, I would try to go there and try to learn things and try to meet people, and in doing so, try to be useful. And in that way, I was lucky enough to have mentors at many, many steps along the way who offered opportunities to me that I never expected and I was frankly not prepared for. And they nonetheless had enough confidence in me to offer the roles, and I was willing in many cases to take risks and make sacrifices that maybe other people would not have thought they wanted to do, and as a result have had an incredibly challenging, incredibly satisfying career which continues. And I've always just wanted to be around people I admired and who could teach me and invest in me, and that's been my whole career pattern.
So if you didn't catch the Pennsylvania piece of her background, that's where the Stanley Cup rings came from.
Exactly.
This tenacious woman is also an owner of the Penguins.
So, exactly. And I will say that with all the great experiences that I've had in my business career, that drinking from the Stanley Cup in the locker room,
Can you picture that?
It beats everything, definitely, including having children and getting married also.
And I can tell you unabashed, if you've not sat on the sidelines, always in the front of a sporting event, it could be the NCAA finals, it could be the Steelers.
Exactly.
With Deb Cafaro, you haven't lived.
Exactly. And I know what the turnover chain is, too.
Right. So, again, we have a lot of generations in the room, and I, frankly, am bored by the conversations about millennials and Gen X's and, how do you manage them? We love young people who bring new ideas to our organization and see the world through a different prism. Ventas not only talks the talk, but walks the walk. You just were named in the top Bloomberg companies for diversity, for all of the things that all of us aspire to. Talk about how you manage that in the context of actually filling jobs that have to get done.
Yeah. Well, luckily at Ventas, we have a very small employee base. And I really think that helps us a lot because we really only hire a couple people every year. And I am really committed to diversity because it is indisputable, it's proven over and over again that diverse groups make better decisions and deliver better returns. Period, full stop. So why wouldn't you want to have a diverse group of people, whether it's at the board level, whether it's at your incoming employee level, and everywhere in between? And that includes gender, race, of course, every dimension that you can think of. We hire people who aren't Pittsburgh sports fans, for example. And so it's not easy, though, and I do think millennials are wonderful. I do think that there is maybe less of a culture of paying your dues in that cohort than kind of I grew up with, and that's something that we try to instill, and we interview for that. Are people ready to be useful, or do they want to kind of run the company on day 2? And so that's the encouragement I would give. But we do want to live our values on all matters related to the environment, our social commitment to our residents and our communities, and of course on diversity. We want to live our values, and we work hard to do so.
So running the company from day 2 is why I'm interested in hiring here at University of Miami and not from my alma mater. They all want to run the company on day 2.
Exactly.
So let me ask another question. As an owner and operator of real estate, it used to be that we were asked about delivering, NOI. And then it became a little broader, and people became interested in things like what happens if there's an epidemic and the flu. And now we're barraged with what our utility bills are and whether or not we're supporting a sustainable business and
Yes.
doing the right things. Are
Yes.
we LEED gold and silver, which we are now building to? Why is that important to Ventas and your peers? And how do you see that playing out when you're balancing first cost, and long-term sustainability?
I just want to take one moment because I have two of my favorite millennial teammates here from Ventas with me, Mary Claire and Miriam. Are you here? There's two very wonderful Ventas employees who are incredible contributors to us, so I'm very glad they're here. So going to the sustainability point, so Larry Fink made a big splash when he talked about stakeholder, working for stakeholders, kind of moving away from the old Milton Friedman, we are simply here to maximize shareholder value. And I really believe that that maximizing shareholder value, which I do care deeply about, we as public companies are here to deliver value for our shareholders. But I also believe that all of the things that we talked about, developing your employees, providing good benefits, making your buildings sustainable, and all of our research and innovation buildings are going to be LEED certified, and we try very hard to also implement sustainability initiatives in our existing buildings. That is all consistent with delivering sustainable value for shareholders. They are supporters too, and you still have to make a sustainable cash flow, of course, but I do think they help you in the long run build a sustainable cash flow model, have the universities and hospitals want to do business with us because they know that we are good contributors to our communities. And in the end, that benefits our shareholders. And it's worked so far.
So to use the sports analogy, we're now in overtime. So I'm going to let Andrea see if we have any questions.
We do. We have a lot of questions have been popping up here. It is so nice for me as a finance professor to hear actually the word shareholder value mentioned from the stage and sustainable shareholder value. I have also new technology that I've put my glasses on to use, but we do have questions from the audience, and I have tried to synthesize the ones that I think would be the most relevant. And the first one has to do with the fact that the U.S. healthcare system is very significantly different from systems in other countries, and given your expertise in the market, what do you think the strengths and the weaknesses of the U.S. systems are, and how does that impact your real estate investment?
The strengths are obvious. You can get the best healthcare in the world in our academic medical centers in the U.S., the best, bar none, at the highest 0.1% level. The weaknesses are that we spend twice as much as many of these other countries, and our outcomes are actually inferior to many of these countries. And so trying to preserve what's best while improving outcomes for the greatest number of people at an affordable cost is really what the challenge is.
We have heard lots and lots of people say that the age of the baby boomers, as they're moving into the fact that they might be interested in senior space, is something that people anchor to the same 60, 65 that we have always talked about. But if 60 is the new 40, then should we maybe be thinking that 70, 75 is the target age before people will move in?
Actually, the target age for customers, even in independent living, is move-in at 84. And
84.
average age is in communities is probably 86, 87. And believe it or not, it's not different in independent living
Right.
and assisted living. Independent living residents are people on the verge who may quickly need assistance. And people who are younger, remember Deb said that the penetration rate is only 10, 11% across the country. Actually, here in South Florida, it's like 7%. So there aren't that many people in seniors housing and care. That's really our big opportunity. But the ones who are coming are much older.
Right. The one thing I would say that's interesting, and I mentioned this Quebec investment, we made a $2 billion investment in Quebec this year with a really different model where people do move in their 70s. It's really independent living light. So all services are a la carte. They're apartments. The average length of stay is about 7 years, and the monthly rate is in the 2000s, so very accessible. And that is something we hope to learn from, because that's not a widespread model here in the US. And trying to figure out if that's just a cultural phenomenon where multifamily living is much more accepted, and so the penetration rate there is 20%. So trying to see what the magic is there to see if that could be adopted here in the US, and then the move-in age is in the 70s.
And do you think, looking forward, what impact do you think telemedicine will have on healthcare as a class?
I think telemedicine is a great supplement to healthcare, and I do think it will be adopted in the homes of seniors who are in senior living. It'll be a great access point there, and I do see it as a way to reduce overall healthcare costs in the U.S. in an effective way.
So if I can add to that, anybody who knows anything about elderly seniors knows that the largest risk to them is to go to the hospital. Because they come back usually, either you have a sentinel event where you need to go very, very quickly, or you shouldn't go at all. So the opportunity that telemedicine affords is huge. At the project that we're getting ready to build with Baptist Health, we will have it fully engaged in telemedicine, even though Baptist Health is going to have a wellness and healthcare facility at the bottom of the building, but not displacing a senior to places where there's a lot more infection, where the waiting rooms are freezing, where they forget their hearing aids when they go and they're yelled at, as opposed to triaging on the screen. And I use it now with Blue Shield, where I call up the nurse and say, I don't feel good, I'm on the road, and she looks at me on Skype and says, I'll write you a script. I think it's great.
I don't know what started that. This last week, notwithstanding, we typically think of healthcare stocks as being recession resistant. Is that a good point of view to have?
I would say in general, in the REIT sector, for example, the healthcare stocks, the healthcare REITs are prone to be thought of as defensive, and therefore outperform in periods of time where economic growth is slightly lower, and periods of fear, and they're perceived to be less growthy, although we've grown pretty much over the years. But that, it is true, we have the kind of business that is event-driven, it's a little bit need-driven. There's a tremendous growth in the demand profile, and therefore it is somewhat resistant to the volatility that comes in economic cycles.
Yes, and let's hope this current last couple weeks is just an aberration. As someone who is standing up here thinking about the future, and also many of our students in the audience have a much longer horizon than I do, just to close, I would like both of you to take a flyer and speculate on what the healthcare industry will look like in 50 years.
5-0?
5-0.
I'm going to let Patricia go first.
Well, obviously, it's going to look dramatically different. We can't imagine what, with the advent of technologies, anything looks like even 5 years from now. And so when we think about the advent of technology in healthcare and the ability, not so much, I'm not sure that we'll never need hands and hearts for taking care of frail elderly seniors. I'm not sure that we'll never need socialization, or that they won't need socialization, but I do think that overwhelmingly technology will look tremendously different. In my experience as a board member of the gerontology school at USC, I can tell you that the researchers will tell you that although the average age is increasing, we're not going to be immortal. So
Thank
we're
God.
gonna top out, in the 110 and above, but we're not going to 150. So if you go long on her stock because you think people are going to live in our communities forever, they're not.
Yeah. I would say the really increasing tailored and genetic therapies for specific DNA is going to help us live longer and healthier. And I want to drive my flying car to see the doctor. That's what I want.
Oh, that would be great, especially in high traffic areas like Miami. You have given us a great deal of things to think about. Thank you so much
Thank
for
you so
sharing
much
your
for being
afternoon
here.
with us.